Top 5 things to watch in 2026 for individual investors before you make your investment decisions. I think for this market to continue to go higher, we're going to have to see AI and technology companies still have momentum to the upside. I think they're still going to have a good year for this market to continue to ride the wave higher. I don't think there's any doubt about that. A lot of people are saying that the markets now are more balanced, and maybe they are than a little while ago, maybe 6 to 12 months ago. But make no mistake, AI or technology in general makes up the largest component of the S&P 500. Almost half the S&P 500 is technology. Trade pitfalls. What could happen? Well, we know USMCA, or CUSMA as we call it here in Canada, is up for renegotiation. I have to believe that trade negotiations between US, Canada, and Mexico will dominate the talk in the first half of next year. Fed Reserve being dovish. We touched on that last segment. I think the Fed's going to have to remain dovish. Perhaps see as many as 2 interest rate cuts in 2026, or perhaps maybe a few more. Potential market risks. Now, this was something that Deutsche Bank came out with, and they listed a bunch of their risks for the market in 2026. I thought I would bring some of those to you as part of our top 5 list. And our last one, normalized returns. I think individual investors need to keep in mind that returns will be a lot more normalized, in and around 8 to 10%, closer to 8% on the TSX, closer to 10% on the S&P. I think that should be the expectation for individual investors. So let's go on with our first one, AI and tech momentum. A great picture there. Our first chart talks about how AI has pushed tech stocks ahead of the pack. You can see here the S&P 500 has done extremely well, but look at tech. Look how well tech has done. And as I said, I believe that tech has to continue to do well for the markets to continue to do well, especially considering tech makes up 50% or maybe a little less, maybe closer 40 to 45% of the S&P 500. And, for the markets to continue to roll, I think names like the Mag 7 and others, the Broadcoms of the world, the AMDs of the world, some of the other older names that we've talked about for many years prior to the last 3-4 years, like an IBM, like a Cisco. I think these are the names that are going to continue to do well, especially if we want to see the S&P 500 surge higher. Our next topic, or our next on our list of the top 5 things that need to go right for the markets and that individual investors need to focus on, we have trade pitfalls. And as we said, there you have it. You have Canada, US, Mexico, and the big word trade underneath. Our next chart here shows how America views of NAFTA and USMCA. You can see there, overall, do you think the US, Mexico, Canada free trade agreement, what do you think of it? And you can see here, well, once upon a time, it was called NAFTA, North American Free Trade. Now it's called USMCA. And is it good or bad for the US economy? And you can see different parts of the, of the population. Overall, Republicans, Democrats, independents, but it's all coming in and around, let's call it 75%. And you can see here that 75% in general, of the population think that USMCA, or whatever they're going to call the trade agreement this year, maybe the same, maybe they'll change it. Everybody seems to think it's important. I know the president has said that he has no problem walking away if things don't work out, but I think many people believe that that is just a bluff and that he needs to have a trade agreement just like Canada and Mexico do as well. Our next point, number 3, that individual investors need to be focusing on and hope for is a dovish Fed. Dovish meaning a Fed that is looking to cut interest rates more than likely. We've had Jerome Powell and the Federal Reserve cutting rates a few times this past year, 2025. But what will they do in 26? Now, if you're sitting there wondering, well, yeah, if the head of the Fed comes in and he is dovish and wants to cut, he's only one vote. And you are correct. The head of the Federal Reserve is only one vote. The vote is tabulated with all the other governors giving their, or voting governors, I should say. There are many governors that don't have a vote this year. So the voting ones, they will tally up what they believe is the way to go, and we'll see what we get. But definitely, the head of the Federal Reserve is usually, or has the most influence usually. So it is quite important who the head of the Fed will be. Our chart here for this third point of the Fed, there it is. Talks about the target range for Fed funds rate. And you can see now that it is 3.5 to 3.75. Many believe that that could be as low as 3% by mid-year. And then we'll have to see what the second year or second half of 2026 brings. The next, number 4 of our top 5 lists for 2026 that individual investors need to be mindful of. And these are the risks that I mentioned. And this is from Deutsche Bank. And they talked about potential risks that could happen to the stock market. There you have them. And the first one, tech valuations plunge. As I said, tech valuations or technology is so important to the stock market. 57% say that this is the number one risk to the markets in 2026. New Fed chair pushes for aggregate cuts and causes market turmoil. So they're saying if the Fed cuts too much, that could cause market turmoil. 27% have that as an issue or a risk. 22% say a crisis in private capital, too much borrowing by some of the businesses like OpenAI, the parent of ChatGPT. Bond yields rising 21%. Central banks hiking unexpectedly. That one you don't see a lot of. That one is the next one. And if you go all the way down to 10%, turmoil in crypto assets. People think that that could be an issue at some point this year as well. So that is the, I guess, the fourth point that we wanted to touch on for our top 5 list. And last but definitely not least, number 5, normalized returns. And our next chart shows normalized returns. Return on investment. What should you be expecting from your investment? Should you expect another 30% year? Well, I don't think so. Here's the TSX returns for this year, 30%, greater than 30% returns on the TSX. Dow Jones, 14%, S&P 500, 17%, and the NASDAQ coming in approximately 22% gains. And this is following gains that we received over the past few years, which have been tremendous as well. So I think we need to ratchet down our expectations a little bit. I just don't believe that we're going to have the same kind of year as we've had this year and the previous 2 years. I think keep our expectations grounded, keep it more normalized in that 8 to 10% range. And I think that the expectation should be that. And if you have the right expectation, that should not lead you astray, and really should not lead to emotions, having these high emotions, maybe perhaps the emotion to get out of the market if things are going down a little bit, or perhaps buy when things are moving higher by quite a bit. You want to stay even keel as best as you can. And that's the job of an investment advisor, the job of myself, to keep emotion out of investing. So for me, these are the top 5 things that I think individual investors should be focusing on, and the top 5 things that I think the market needs to have another good year, another positive year in 2026.